Hello and welcome to The Enterprising Investor, the flagship investment podcast for CFA Institute. I'm Mike Wallberg, and I'm joined today by Alfonso Ricciardelli, who co-edited a recent paper for the CFA Institute Research Foundation, which provides an intro to alternative credit. Alfonso's resume includes a few interesting turns, including a couple of law degrees, time spent in politics in Brussels, and an extended stint advising institutional investors on political risk from perches in London and New York. These days, he's developing Nusk, a platform he co-founded that allows users to share knowledge-based content in the legal, finance, and marketing areas. And I do hope to get to that later, but first, we're going deep on alternative credit. Welcome to the show, Alfonso.
Thank you, Mike, and thanks for having me.
So, Alfonso, start us off by talking a bit about why you, Philip Clements, and the others decided to put this brief together on alternative credit.
Yeah, I have to say it's mostly Philip Clements' fault because at the time I was working for a platform that expanded access to retail investors for most alternative credit products and also different private market products. At the time, Philip and I thought that within the CFA Institute's broad spectrum of topics, this was one that was not really where the institute was not really focused on or didn't really have a lot of material on. I think it's so in the CFA curriculum you can see that as well. But we because I was working in the field and he had good knowledge of the field, we realized that we could really put together a bunch of good writers in their respective sub asset classes. Phil did a great job putting together the roster. I helped with the writing because this is something that I used to do. And overall, I think it came out pretty nicely and it was well received. Now, this is an additional piece of information, but we started writing this at a time when interest rates were low and interest in the asset class was huge because people were looking for yields and alternative sources of revenues in the financial services field because public markets were mostly overly correlated and very crowded. And so, long story short, it was an incredibly popular field. And then, at the end, when we actually published it, some issues started to appear because of the changes in market conditions. And so that actually probably made it even more interesting.
Yeah, that's right, and we will definitely get to some of the issues that are cropping up there. So thanks for reminding me on that. So before we get there, though, so under this banner, you have a lot of subcategories: you got direct lending, CLOs, consumer loans, trade finance, the ever popular or not real estate loans, and then infrastructure and venture debt. So broadly speaking, can you speak to how did we get here and why is now the time of such great interest in alternative credit? Keeping in mind that obviously things have changed since late 22 when you started this project and we're in sort of mid 24 now. And as a category, what sets these things apart from traditional fixed income?
So I think the most interesting piece of information that comes out of this is exactly what you said about the number of sub-asset classes that are there. Some of them are more well-known, what you said, real estate debts, CLOs, even consumer loans, if you will, which have also become very popular during the pandemic times. And some of them, I think, are less well known. I would say venture debt for once, although it became infamous with Silicon Valley Bank. It isn't. It is just a small asset class. It's just a bunch of billions, probably 30 or 40. But that part was super interesting for me too. Having also started a company in the meantime. And to see how it works and how do they de-risk. But generally speaking, alternative credit, as we said, it can't really be defined. But most people use private credit and alternative credit as the same kind of to indicate the same kind of asset class. But it's not really that. I think alternative credit is a better definition. It encompasses a number of transactions that are completely different from one another. I think infrastructure, for instance, and CLOs are completely different risk return profiles, which is the reason why, differentiation even within the asset class is very important when you're thinking about an allocation. And most importantly, as we said before, at the time, it seemed to be an interesting topic also from a regulatory perspective in terms of retail access or generally speaking, expanding access to all these sub-asset classes. I think you've mentioned real estate debt. I think now we've come to the point where real estate debt has become very interesting. Well, for a number of reasons, we can get to it later. But generally speaking, for me personally, having read all this venture debt, I would say direct to consumer loans, those are the ones that captured my attention because it's so interesting to see the other side of things. I don't know if you want to get more into them specifically, or in terms of their risk return profiles.
Well, just more broadly, Alfonso, so basically like at a point in time when these things started to have their ascent, I mean, they always kind of existed in the background a little bit, but was it basically the banks kind of stepped away, regional banks with SVB sort of accelerated some of this disintermediation by the private equity? Do I have that right?
Yeah, so it's a post-GFC environment where banks started like moving away. Again, regulation playing a really important role here. Banks started wanting to take less risk, both because of regulation, but also because of they've been burned, and so there opens up an opportunity for different players in the field. I'm thinking about real estate debt and private credit. Private credit, I think, basically. I think the value, the size of the market has increased tenfold. It used to be 200 billion, now it's like 1.7 trillion. And, so.
Which is bigger than the high yield markets, right? And loans.
It's incredible, yes. And, people compare it with the high yield market, but, you have to ask yourself, and sometimes they say, it's in terms of risk return profile, if you look at it, it's, I don't want to use this word, but it's like better, but take it with a grain of salt. And there's been this discussion where some of these very attractive risk return profiles would actually be helpful to build better portfolios. I think the World Economic Forum had a bunch of graphs. They issued a paper probably end of last year, and they had one graph that showed the reduction in risk and the volatility and the increase in return profile of portfolios that included larger allocations to private markets. Now, I'm not gonna go deep into that argument because I don't know how to structure a portfolio myself, but I would say that it's if the case has been made, there must be a compelling argument to at least include more of this in a traditional portfolio.
So we had a time more recently, it was a couple of years ago, where you had low yields for a period of time and the banks backed away, got these new players that are offering these products, and the products are largely, private structures. So anybody that's in them has to deal with that illiquidity. So you're picking up an illiquidity premium. You're getting a little bit more anyways. And then so fast forward to today, we've got, rates are, well, they're still hanging in there high. The Fed still seems to be holding off on their cuts, but it's a bit of a different category now, and we've started to have some negative headlines hitting on a number of these different subcategories. So what's on investors' minds here? And are there any areas more or less susceptible to this weakness?
Yeah, I mean, it's important to say that especially with private credit, it's mostly floating rates. So from the investor's perspective, in theory, at least, if the market doesn't start there, if there is an enormous amount of stress in the market, from the investor's perspective, the investor would probably be okay, with rising rates. But the problem is, of course, the person the company that has to pay the loan. So the other side is the one that is put under stress. And so, we'll have to see whether default rates really increase to a level that is prejudicial to, investors' returns and generally speaking to the entire market which is now 2 trillion large, kind of systemic in a way. So I think that the most important consequence is on the payer side, more so, at least in theory, than on the investor side. And the investor in theory is okay, but we'll have to see, and also we'll have to see in terms of structuring new loans. Right? How many? I think there was a recent case with an Italian football team company where they had to renegotiate a private loan, and then they're like, okay, the interest rates are going to go up big time, so they eventually ended up relenting and renegotiating it. So I think this is one of the problems that the market has in general at this stage, especially for private credit. So even if in theory, it's interest rate neutral in some ways, and then there is some leeway because, as you said, the interest rates at the origination are slightly higher, so they make up for potential future illiquidity, illiquidity premium. But still, in an environment where there is increasing defaults, then that's definitely an issue for the asset class, especially as it's become so big.
Yeah, because it has its own sort of in contagion when there's that visibility into struggles with liquidity, right? So because you start to get a bit of a run for the exits. I mean, we had in Canada today, we had 9 Point as a provider that's been, on and off with gating their redemptions for the last couple of years, and just this week they're up again. And if you look more broadly too to the allocators to it. So I mean, our big pension plan, $640 billion Canada pension plan here, is getting a lot of heat right now for the fact that they have a more complex structure that has, allocations to things like private credit and illiquid assets. And I mean, the criticism is that those funds or those structures aren't able to even keep pace with public markets. So it feels like to me like this is a time when it's a difficult time to be making the case for private credit.
Yeah, I would add this though, Mike, that there was a time where pension funds in the U.S. were absolutely destroyed during the great financial crisis, and the ones that were invested in public markets lost a lot of money. So if you were to retire at that particular time, you would have suffered greatly. So I think generally speaking, there will always be cyclicality in markets, even in private markets in some ways. But one point I wanted to take home here is the fact that the liquidity, yes, is an issue, but it is precisely long-term allocations like pension funds that I think are better suited for these more sort of illiquid allocations, or at least to include more of these illiquid allocations. So I'm going to go against the grain here and say that despite what's happened in Canada, I would still say that if you want to make the case to expanding access to private markets in general, private credit specifically, one way to go about it is to use vehicles that have very long time horizons.
Yeah, I totally agree with you. And I think I wrote a piece, an op-ed for the Globe and Mail here in Canada a few weeks back, and was arguing that institutional access to these things makes sense and has done for a long time. And we can get to why don't we talk about retail a little bit here, because I know you also you've also written a piece for our namesake blog here, the Enterprising Investor at CFA Institute, that made the case specifically for more retail access to alternative credit. So I'll let you go first. What's the case for broader distribution of private credit across retail?
Well, I think I'm going to have to go with what the World Economic Forum said, which I think was partly copies from something we said when I was working for Yale Street back in the days, which is that it usually makes for portfolios that have a better risk return profile. In some ways, the expansion of access is not just an expansion in terms of allowing investors with more limited means to access them, but also expanding access and, let's say, in terms of reporting to wealthier investors, because there are several issues with private credit, several problems that have to be overcome when it comes to access. One of the problems is transparency. You have reporting is more complicated than it is, for instance, for public market companies. So even if you're a very wealthy investor, it's harder to understand in some ways. So that's one issue. Another issue is, of course, is the very large ticket sizes that you need to fulfill if you're allocating to a fund, for instance. Another issue is regulatory constraints when it comes to the amount of assets that you have to own in general and the amount of money you have to make per year. Also, though, and I really like that side instead of the regulation. I don't really like the others, but this one I do, which is education. If you do have financial education, then your access is easier. And I think that's a good thing. I think people should have as much financial education as they can in general. And then that is a much better way to sort of discriminate between who can access these kinds of products and who cannot.
Yeah, totally agree. And a lot of those points there. And obviously a good starting place for your education is to read this piece that you did for the CFA Institute. But yeah, so I mean, I guess there has to be some kind of a burden on the manufacturers of these products to help make sure that that their investors understand the risks with them. Specifically, and my big bugaboo is the liquidity risk, because I feel like the folks that are getting burned and the stories that you're reading are people who kind of got into them and didn't really understand when they got in there that could be a day when they want to get their money out. And the issue is that it happens is, of course, when you want their money. It's like insurance, right? It's like when you want your money is when everyone wants their money, and that's the time that you're least likely to be able to get it. That's when stuff's going to get gated. So I guess education to them. But I guess the question is how, back to regulation, like how do you ensure that the manufacturers of this adhere to some type of, or is it advisors that are putting their clients in it? They understand, and also that they don't over allocate to them either, because that's another big piece of it, right? Is if you buy a 5% sleeve out of your portfolio, big deal, right? Probably. But if you're 10, 20, 50% of your clients' assets in private assets, which does happen, unfortunately, that was part of what prompted my article. But anyway, sorry. What do you think?
No, this is it's very interesting, and I think you obviously have a point. There is always a balance that needs to be kept with regulation. Being for a regulator for a brief amount of time, I worked on MiFID II while I was in the European Commission. Yeah, very, very briefly. I understand the need to balance out the various interests. However, here's what I will say: there is sort of a discrepancy in the regulatory environment, because if you are a retail investor, you can access certain products that are extremely high risk, binary options trading platforms, crypto,
GameStop,
this stuff. Yeah, sure. That's on the regular trading platforms, but yes. But even stocks that are good stocks, but they're overbought sometimes because investors flock to them. And yet, if a transaction is structured, or better than a single transaction, if a fund is invested into by institutional investors, so it has institutional grade sort of due diligence made by other players, then the question is, why are we not filling that educational gap and are allowing people? In this World Economic Forum report, which is actually very good, there's two categories. One is the affluent category, which is people who have assets between $250,000 to $1 million. I think that's being able to expand access to them, which is now limited because, of course, you need to have more than 1 million in assets in many countries. I think that would be, especially at a younger age when people are just starting to invest their money, I don't see how that could be a bad thing. And for the liquidity issue, I agree with you. It is a problem. Timing is always a problem with markets. But, better secondaries, like expand the size and scope of secondary markets to provide, potential liquidity exits in longer time horizons, as we discussed. Those are all solutions that regulation can adopt. And I think the SEC has been tapped on this 2019, then again 2022. So, at least in the United States, I expect some level of movement in that field. Hope that wasn't too long.
No, that's great. And I guess touching on your point about education, I know that you built Nusk as I understand it, basically as a way to sort of counteract some of the wild west of the finfluencers online. And correct me if I'm wrong about kind of what one of its goals are. So can you talk a little bit about what Nusk is and what it kind of hopes to achieve?
Yeah, we built it because we had the impression, at least as soon as we started analyzing the market for, knowledge online, we came to the realization that there was, as you correctly said, a Wild West. Now, if you go on these platforms as a retail investor who has no knowledge of finance whatsoever, you are easily drawn to the people that shout the loudest or pretend to give you advice, but really what they want to do is selling you their courses where they teach you how to make 1% a day in the stock market.
Sign me up.
Yeah, those extremes are, those are borderline frauds. There's also there's a lot of charlatans and so on. But that said, people use social media for their own education, and for some things it works. The same way that, for cooking, so some people learn how to cook on TikTok, but then other recipes are terrible, and the food looks absolutely terrible. But so the same way with finance or with politics, there has to be some level of understanding of who is really providing value out there. Now, what I will say is that we had some trouble building network effect because a lot of people these days are using LinkedIn as a platform for knowledge sharing. We'll see if we manage to build an experience that surpasses that one. But I think that generally speaking, the world of social media needs to come to terms with the fact that there is a lot of good in it, but it's also incredibly devious and terrible for para-educational purposes. That people think it's educating, but they're not getting educated; they're just getting bullshit information. So sorry to say that.
It's okay. So basically, then Nusk then would provide a vetting, some type of a environment where people can go where they can feel confident that the people who are talking know what they're talking about.
We thought about it in many ways, but mostly from the point of view of who's sharing knowledge, right? Let's say, Mike, that you want to share knowledge about private markets on social media. What we want to make sure is that you don't have to share a platform with people that say you got to make 1% a day in the stock market.
Right.
And so I think that's also for creators, so to speak.
Yeah, one of the things I thought was really quite interesting from your blog post was, I'm going to quote it here. You said, authors of a study that you were looking at said that 28% of influencers are skilled, generating 2.6% monthly abnormal returns. 16% are simply unskilled, and 50% are anti-skilled, generating negative 2.3% monthly abnormal returns. So you've got this really terrible landscape that you're dealing with. So it seems like a worthy cause, for sure. And to your point about cooking, which I've definitely been on the wrong side of that, but the downside is much higher for people that are getting bad financial advice than getting bad cooking advice.
You can definitely say that.
Well, we're coming to the end of our chat here, Alfonso, unfortunately. So I'm gonna hit you with our two-parter at the end here. What was your first job in the industry? And if you could go back and take yourself for coffee on your first day, what key piece of advice would you offer yourself?
Oof. So my first job in the industry, if you can call it that, was I started working for a company that advised institutional investors on political risk. It started during the Euro crisis, and I met this guy, and he wanted some information about Italian politics. It was the Euro crisis, so I'm sure you can remember the days of Berlusconi, and I happened to have spent a lot of time in Brussels, so I had a lot of information about what was going on at a regulatory level, at a political level. And so I started collaborating, and then he said, "Can I pay you?" And I said, "No, just hire me." And that was a 5-year period. And when I started, I didn't know a stock from a bond. And then I did the CFA program from start to finish. It was interesting. For a lawyer, it was very interesting. At least I didn't have problems with ethics and the rules, the first part, which everyone seems to hate, but I absolutely loved it. And then coffee advice. For people in the financial industry, for sure, I think it's don't take yourself too seriously, because it seems to be an industry where people tend to take themselves so seriously. And at the end of the day, I understand the need for gravitas and so on, but your personality is your personality. So you don't have to look like Jamie Dimon all the time. And actually, Jamie Dimon is quite funny. So wouldn't even, so don't take yourself too seriously.
Great advice. I've been speaking today with Alfonso Ricciardelli, co-founder of Nusk and co-editor of An Introduction to Alternative Credit, a recent brief from the CFA Institute Research Foundation. Great chatting with you today, Alfonso. Thanks for coming on.
Mike, thank you so much.
I'm Mike Wallberg, and this has been The Enterprising Investor.